We can go to the next slide. Okay. So why ESOP valuations? Honestly, for us as a firm, we are seeing this as one of the emerging segments, and the reason is simple. First, there has been a widespread adoption of ESOP schemes. It has really become a buzzword in employee benefits. Employees want it; they treat it like a promotion, and companies are unable to avoid it. It has become a necessary tool in their comp and ben toolkit. In fact, we were doing one of the research when we did one of the research recently around the assumptions adopted by various listed companies. We found out that most of the 50%, more than 50% of the recent listings that happened in the last 2 years offered to their employees some form of ESOPs or share-based incentive schemes. And this adoption is much higher in case of startups, particularly mature startups. It's not just the adoption of these ESOP schemes. The magnitude of grants have also become much bigger, in the sense that companies are doling out much higher grants compared to what was observed earlier. And as a result, the charge coming to income statement from such schemes has increased over a period of time. Again, going back to the research that I was referring to, we noticed that the charge for the companies that listed in the last 2 years was on an average around 6.5% of PBT for these listed companies in the last financial year. And that's quite significant. All of this, coupled with the fact that we have now moved away from guidance node and moved into IFRSs, which require accounting on fair value basis. Now, if we were in the era when the IFRSs were not implemented, and the ESOPs were granted at par, the companies could actually get away without booking any cost, but not anymore. You have to book a charge under Ind AS 102 on fair value basis, and of course that has meant more and more need for valuation of such schemes. All of this, coupled with the fact that schemes are increasingly becoming more and more complicated. Now, what we do notice is that employers or the companies are trying to make all the ends meet, in the sense they want to keep their charges less, the dilution to shareholders minimum, and they want to keep the employees also happy with potential for significant wealth creation. Now, given all of this, we are seeing that companies are becoming innovative and employing interesting vesting criteria and exercise terms in their ESOP schemes, and all of that has resulted in more complications, and hence we feel there is need for increase in awareness around these things. So all of these reasons have contributed to us feeling that there is need for such a webinar, and perhaps create awareness and see how we can build towards the collective capacity building around this area amongst our clients and prospects. Now let's just, before we get into the details, let's look at what ESOP valuations are, what it entails. Now, this is one slide where we're trying to give an overview of the entire journey. And a very simple term, you grant ESOPs, they vest, and once they vest, employees exercise and they make money. Now, from an accounting perspective, the grant of the instrument and the vesting of the instruments are very important milestones, because that is the period within which we are recognizing the expense. Now, just to give you because I want to summarize the whole thing in one slide, let's consider a very simple example, a plain vanilla ESOP grant to employees, where the vesting is done over a 3-year period, with 33% of ESOPs vesting in each year. When we do the valuations, basically there are very simple 2 steps. First, on the grant date, when you do the grant, you have to determine the fair value of options. Now, because this is done at grant date, and for equity settled instruments, this does not change throughout the journey. Hence, we say it's very important that you get the mathematics right before the grant, because there's nothing much left to do after the grant. In case of equity settled instruments. In case of cash settled instruments, this fair value is determined on each external reporting date. Now, to determine the fair value, there are 3 key inputs. We'll be going through these in details during the next 1 hour. The first one of them is models. Now, virtually everyone on this call will know that the 3 key models that exist around option pricing are the Black-Scholes model, the binomial model, and the Monte Carlo simulations model. Black-Scholes obviously is the most widely used model. And of course, as we'll see later in this presentation, it works perfectly for plain vanilla ESOP schemes. But if there are complications in the scheme, then you have to use more sophisticated models, which include the binomial and the simulations model. Now, when I say complications in the scheme, the key complication there being the market linked vesting criteria. And we are seeing companies say that increasingly say that your ESOPs will vest only if the share price doubles, or or it goes up by 20%, 30%. So there are such conditions that are getting imposed. And in case any such criteria is there in the scheme, then Black-Scholes will not work. You will have to use more sophisticated models. Interestingly, we have seen companies, choose simplicity over accuracy, and we have seen companies use Black-Scholes even when they have some of these criteria within the scheme. Now, not only is it resulting in inaccurate determination of fair value and hence the charge, it is actually resulting in an excess charge to the income statement. So one of the things that we as practitioners need to check is my scheme plain vanilla and hence a Black-Scholes can be used, or are there any vesting criteria market linked which necessitate use of more sophisticated models. That's one of the inputs into determining the fair value of ESOPs. The next is assumptions. And there are 6 assumptions that are mentioned over here, as you can see through the around the cursor. You have the share price as an input, you have the exercise price as the input, you have volatility, you have the term of the ESOPs, that is the term over which they're likely to be exercised, the rate of dividend, as well as the risk-free rate of return. We'll be going through all of these in this webinar, but the key ones here to discuss will be volatility and the term of the ESOPs. These are the ones that can have significant bearings on the outcome. These are also the ones which increasingly companies try to, see how they can best optimize from a cost perspective. And these are also the ones where auditors question the most. So it's very important to get these right when you are doing these valuations. We'll be talking about these in a little while. And then, of course, it's data. From a data perspective, we have seen the companies not very good in terms of how they manage their data around grants. Now, we'll see in 2 minutes how this impacts your valuation process. But it's very important that if you are doing these instruments, you maintain the data in a very good way. This is particularly important if you are doing a widespread grant. If you are doing a grant to 5-7 top people of the organization, fair enough, you can maintain it in Excel. But if the grant is to say 150, 200 people, there has to be a very good process around how this data is maintained, because we will need, from a valuation perspective, every date when was granted at a grant level, when did each of the option vest, when did the employee leave the organization, if at all they left the organization, when were these options exercised, and we need it at a grant level. So if each employee has been given 4 grants and there are 200 employees who have been given grants, we basically need 800 rows, and with all these dates properly mapped out. So data has been one of the struggles that we have seen when it comes to valuations, particularly for companies where the grants are done to a large number of employees. And this is one area where we can do better. But these are 3 key things that go into determining the valuation of ESOPs. Once we have determined the fair value of ESOPs, the second step is simple. We need to spread the cost over the vesting period. Now, in this example, if you notice, we said that it's a 33% vesting each year. So how we will spread the expense is, we'll spread the options that are vesting in year 1, the whole of that expense will be spread in the first year itself, will be recognized in the first year itself. For the options that are vesting at the end of second year, the expense of that will be recognized in 2 years. So effectively, some of the expense here will be recognized in year 1 and some in year 2. And the ones which are vesting at the end of 3 years, their expense will be spread over the 3 year period. Uh, if you visualize this, you will understand that the expense here is quite front ended in nature. So the moment you do a grant, and if you may think that it's linear vesting 33% each year, but the standard says recognize the expense from the grant date to the vesting period. And just because of this recognition pattern, the charge is usually front ended. Hence, it's very important that if you are doing grants to employees, get the mathematics right before doing the grants. Make sure the charge is palatable to you. Make sure the employees are happy with the grant. Make sure the dilution is within reasonable bounds. Something that all of these things should be ensured right at before the grant is. Once you do it, the expense and the outcomes will largely in line with your expectations, and you will not have any challenge. Two, 3 points I'd like to highlight here. The accounting standard says that, as we had discussed earlier, that in case there are any share price targets or shareholder IRR, that is the market linked vesting criteria, those need to be factored within the fair value of options. But in case there are non-market linked vesting criteria, for example, the company must achieve sales of 1,000 crores, or the employee must be rated at least A or B, then those need to be factored in here in spreading of expenses by determining. So we find out effectively how many options are actually expected to vest, and only to that extent we recognize the cost. So all the non-market vesting criteria are taken care of in step 2 and not in step 1. Couple of more points here. Supposingly we say that 10% of the options will not vest. That's our expectation because there are some such criteria. As we progress through time, if we notice that the actual experience is more or less than the expectation, we have to true up the charge on each reporting date to reflect the fresh expectation. And of course, by the time the vesting happens, the actual vesting needs to be recognized. One of the key challenges around data that we have seen here is that companies are not able to provide us, in case of exiting employees, exactly when the employee exited vis-a-vis the vesting of the ESOPs. Now, please note that in case an employee exits, the reversal of charge depends on whether the employee exited before vesting of the ESOPs or after vesting. Now, in case an employee exits before vesting of the ESOPs, you can take the reversal of the charge of his ESOPs in the income statement. However, in case the employee exits after the vesting of the options, the reversal is not allowed within the income statement. You can only reverse it within the general reserve. So that's one of the very critical data items. We have seen companies not being able to provide granular enough data for doing this bifurcation for exiting employees. That is, if you have a reversal of say 1 crore, how much of that will be reversed through income statement and how much of that will be reversed through general reserve or accumulated profit and loss account. So that's one of the reasons we highlighted the data is very important, and it's something that you must be mindful of if you're launching such schemes, especially if it's a widespread policy. So very two simple steps: determine the fair value of options, which includes models, assumptions, and data, and then step 2, spread it over the vesting criteria. That's it. The details, let's talk in the subsequent slides. So as the previous slide has given us the areas where we need to focus on to get the best outcomes, or to have controls over the valuation of ESOPs. This slide summarizes the flow that we will be following and highlights the areas of control. The key being valuation models. You have to choose the right model. We see a lot of companies trying to just go with Black-Scholes even when their schemes are more complicated, and perhaps choice of other models may result in better recognition of expenses. So that's one. Next is data and assumptions. We'll be spending almost 25 to 30 minutes around these. As mentioned earlier, there are certain assumptions which are more crucial than others. We'll get into the details of those. It is very important that we get these right. And as I mentioned, Poor data is sometimes resulting in inappropriate calculations. We'll talk about data, what we needed. It's very important that we get those right as well. Expense recognition, largely uh, we have spoken about how the pattern of expense recognition in the previous slide is from the grant date to the vesting date. So that is already there. And at the end of the presentation, we'll be talking about some of the common mistakes we need to avoid when getting these valuations done. We can go to the next slide. Let's start with valuation models. As mentioned earlier, there are three key models that exist. One is the Black-Scholes option pricing model, which is the most commonly used model, and it's actually very widely available. There are some online calculators where you can just go and input the assumptions, and it will give you a fair price. Uh, it's a simple formula based approach to determining fair value of options. It's easy to use, easy to understand, and works perfectly for plain vanilla ESOPs. Please note, as I mentioned earlier, it does not work for ESOPs or stock appreciation rights, where investing or exercise is linked to future share price or market capitalization targets. When some of these things exist, you have to use either a binomial lattice model or a Monte Carlo simulation model. Binomial model basically requires stepwise projections of share price. It's relatively more complicated, requires sophisticated systems, and often has computational delays and difficulty in managing the outcomes. But it is certainly more flexible than Black-Scholes in handling complex ESOPs and stock appreciation rights schemes. Then you also have Monte Carlo simulations, which can be used in case of complicated schemes, something that we at KPAC use extensively for our clients. We basically fit probability distribution to the share price and project the same. And then we build in the conditions that are within their scheme to compute the impact of that on the fair value of ESOPs. These, of course, these models require statistical knowledge, but are highly flexible to handle complicated schemes, unlike Black-Scholes. Please remember, for a plain vanilla scheme, all the three models will result in same outcome or very, very similar outcome. Where the Black-Scholes fails is when the scheme gets complicated and you necessarily have to go to binomial or Monte Carlo simulation.